Yesterday, I told you February 24th was the day that would change everything. Shanghai reopening after 10 days dark. COMEX February delivery finalizing. Two events, same morning, same metal. And I told you exactly what to watch for. It happened. Shanghai opened, COMEX delivered. Silver surged 1.44% intraday while gold dropped. The Black Swan prediction came true. And now, 48 hours before Friday, February 27th, I need to give you the most important update I've recorded all week. Because what is sitting on the books at COMEX right now is not just unusual, it is mathematically impossible to resolve cleanly. Everything in this video is verified and sourced. All numbers are linked in the description. If you are new here, hit that subscribe button right now, because the video I dropped Thursday night, the night before First Notice Day, is going to be the most critical one I've recorded this entire cycle. You need to see it before 9:30 a.m. Eastern on Friday. Let's get into the numbers, because the numbers are where this story lives. Let me start with what actually happened on February 24th, so we are all looking at the same reality. The Shanghai Gold Exchange and the Shanghai Futures Exchange both officially reopened after the Lunar New Year closure. 10 days dark, 10 full days of compressed Chinese industrial demand, institutional hedging adjustments, and position rebalancing, all queuing up behind a closed gate and then releasing into the global physical silver market in a single session. I told you in Sunday's community post, watch silver spot at 9:30 a.m. Eastern. I told you a strong Shanghai Open would push silver above $87 within the first 2 hours of New York trading. Silver traded at $87.82 intraday, up 1.44% on the day. That is scenario 1 from the framework I published Saturday night, the 65 to 70% probability scenario. Chinese institutions came back as buyers, not sellers, buyers at levels below $100 per ounce, after watching the January all-time high of $121.62 per ounce. They are accumulating. The price action on the 24th confirmed it in real time. Here is what most channels completely missed about that move. Gold was down 0.59% that day. The dollar was flat. Stocks were mixed. Silver was the only major asset moving higher. When silver outperforms gold on the exact day China re-enters the global market, that is not a coincidence. That is Chinese physical demand applying direct upward pressure on the spot price, while the Western paper market had nowhere to hide. And before I go further, if this breakdown is giving you clarity on what is actually happening underneath the surface of this market, hit the like button right now. It is the single best way to tell YouTube's algorithm that this data needs to reach other silver holders before Friday morning. You would be doing them a favor. Now let me give you the COMEX picture. This is where Friday becomes critical, and where the math starts breaking down in ways that should concern every person holding any paper silver exposure. As of February 19th, COMEX registered silver inventory stood at 88.79 million ounces. I pulled this directly from the CME Group Daily Vault report, independently confirmed by Metal Chart's public data. Now here is what makes that number alarming. In the last 30 days alone, COMEX registered inventory dropped by 51.9 million ounces. That is a 37% drain of all deliverable registered silver, gone in a single month. To understand how serious that number really is, go back to October 2025. Registered silver at COMEX stood at 167.7 million ounces. Since then, in less than 5 months, nearly half of all registered silver, approximately 47%, has left those vaults and has not come back. Physical buyers took it. Industrial users took it. They did not bring it back. On February 11th, CoinWeek reported that registered inventory crossed below 100 million ounces for the first time in a single session. On that day alone, 3,256,882 ounces were removed from the registered category. The very next session, eligible inventory dropped a further 4.7 million ounces. 2 days, nearly 8 million ounces gone. The average daily drain rate based on public delivery data is approximately 785,000 ounces per day. Do the math on that. From 88.79 million ounces at 785,000 ounces per day, COMEX registered inventory reaches approximately 85 million ounces, somewhere between today, February 25th, and tomorrow evening. Now here is where it gets truly alarming. COMEX open interest on the March silver contract as of February 19th stood at 130,490 contracts. One contract equals 5,000 ounces. That is 652 million ounces worth of paper claims sitting above a registered inventory of 88.79 million ounces. The ratio, 0.14. For every one deliverable ounce inside those COMEX vaults, there are approximately 7 paper ounces that can legally demand it. 7 to 1. Paper to physical, 7 to 1. As of this morning, February 25th, open interest for March has dropped sharply to 22,966 contracts, reflecting typical pre-first notice day roll-off as traders shift to May or close out. That brings the notional claims down to roughly 114.83 million ounces. The ratio has compressed from 7 to 1 down to approximately 1.3 to 1. And some analysts will point to that and say the pressure is easing. They are wrong. In February, approximately 46,100 contracts stood for physical delivery, out of 47,000 open interest at the close of the delivery window. Analysts have placed that delivery rate at approximately 98%. I want you to hear that clearly. 98%. Most months, delivery rates run between 5 and 15%. What happened in February was structurally different, and it is documented in public COMEX delivery notices linked in the description. If even 25% of the remaining March open interest demands physical delivery on Friday, just 25%, that is 32,600 plus contracts. At 5,000 ounces each, that equals 163 million ounces demanded from a vault holding 88.79 million ounces. The math does not work. It cannot work. Now I need to tell you about something that is barely being discussed anywhere else right now. Silver lease rates. Because this is the data point that ties everything together. Silver lease rates represent the annualized cost to borrow physical silver bullion. Historically, in years of abundant supply, silver lease rates averaged between 0.1 and 0.5% per year, essentially free. Lenders had plenty of metal and charged almost nothing to lend it. Today, those rates are sitting at approximately 6 to 8% annualized. That is 10 to 20 times the historical norm. During the extreme tariff stress events in September and October 2025, those rates briefly spiked above 30%. In early 2026, they eased slightly after the January price crash from $121.62 down to approximately $72 per ounce. But they have rebounded sharply as Shanghai reopened and COMEX drain pressure resumed. What does an 8% lease rate actually tell you? It tells you that anyone who needs to borrow physical silver right now, shorts who need metal to deliver against COMEX contracts, industrial users who need silver for production, institutions hedging physical exposure, they are paying 8 times the historical rate to access it. That is not a market with abundant supply. That is a market screaming physical scarcity through the only mechanism that cannot lie, price. And here is something else the lease rate data is telling you. Before the Lunar New Year closure, the Shanghai Futures Exchange was already showing signs of acute physical stress. SHFE silver inventories had dropped to approximately 353 metric tons, a 10-year low. Despite those critically low inventory levels, the SHFE price was trading in backwardation, meaning the spot price for immediate delivery was trading at a premium above the COMEX futures price. Chinese industrial buyers were paying above New York screen prices just to secure physical silver right now, because physical silver in China was that scarce. March COMEX futures are currently trading in the $82 to $84 range versus spot at $86 to $87. Backwardation in both markets simultaneously. That is not noise. That is the physical market trying to send a signal that paper instruments are consistently underpricing the real asset. Now let me walk you through exactly what a COMEX failure to deliver scenario actually looks like, because I want to be very precise with my language here, and I want you to understand what you are and are not looking at. The COMEX does not technically default in the way a company goes bankrupt. They have rules written into their exchange bylaws specifically designed to prevent that outcome. Rule 589, classified under emergencies, allows the exchange to force cash settlement if physical delivery becomes impossible. Rule 701 provides additional force majeure provisions, allowing the exchange to halt trading, suspend deliveries, or restructure settlements if circumstances make delivery impossible. If the demand for physical silver on Friday exceeds the approximately 88 million registered ounces, COMEX will not shut down. They will look at the contracts demanding delivery, look at the available metal, and announce that the remaining contracts will be settled in cash at a premium to the current spot price. They will force you to take dollars instead of ounces. This is force majeure. It is legal. It is in the contract specifications that every futures trader agreed to when they signed up. But here is what matters, and this is the part that separates what I am telling you tonight from what you will hear on mainstream financial media. While force majeure protects the exchange legally, it destroys the exchange functionally. The moment a major commodity exchange declares that they cannot deliver the physical asset they are supposed to be pricing, the paper price and the physical price permanently disconnect. The screen price becomes a representation of cash settlement value, while the physical price becomes whatever a holder of real metal demands to part with it. You watched this exact dynamic play out with nickel. March 2022. The London Metal Exchange halted trading, canceled approximately $12 billion in trades, and forced cash settlements because a massive short position had blown up and they could not physically deliver against it. The LME survived legally, but they permanently lost their absolute authority over global nickel pricing. The UK Financial Conduct Authority later fined the LME nearly $12 million for their handling of the crisis. Physical nickel premiums spiked globally. The exchange never fully recovered its credibility. If COMEX is forced into cash settlement on silver, the immediate result is a massive repricing of every physical asset that is no longer tethered to a broken exchange price. And that brings us directly to why your PSLV position matters in a way that SLV, AGQ, and mining stocks simply cannot replicate. PSLV is not paper silver. It is not a futures contract. It is not an IOU backed by an exchange's ability to source metal on demand. Every single share of PSLV represents a direct pro rata claim on allocated, audited, physically segregated silver held at the Royal Canadian Mint in Ottawa, Canada. Sprott publishes regular third-party audits. The metal exists. You can verify it. The address is public. Let me show you what PSLV looked like at the worst moment of this cycle, so you understand the full picture. When silver crashed from its all-time high of $121.62 on January 29th, all the way down to approximately $72 in early February, PSLV did not just track the spot price. It traded at an 11.6% discount to its net asset value. People were selling PSLV shares for 88 cents on the dollar, at the exact same moment that physical coin dealers were reporting premiums of 30 to 40% above spot on American Eagles. 88 cents on the dollar for a trust holding physical silver, while physical coins were selling for 40% above spot. That extreme spread between paper panic and physical reality was the single most important data point of the entire crash. And it was a gift to anyone who understood what they were looking at. That panic discount has since recovered. As of February 20th, PSLV was trading at a 3.62% discount to NAV, significantly tighter than the crash lows. Today, with Shanghai open and silver pushing higher, that discount is compressing further. Here is what you are watching for into Friday. If PSLV crosses from a discount to a premium to NAV, that's confirmation that physical demand is outpacing paper supply, that buyers are paying above the audited metal value to get physical silver exposure through the trust. That has happened before during previous physical demand spikes. It's a documented historical pattern. Now consider the scenario table. In a base case, where only 5 to 15% of open interest stands for physical delivery, spot holds or rises modestly to the $88 to $92 range. PSLV's discount compresses towards zero or flips to a small premium. Manageable. In a stress case, 25 to 50% delivery demand, registered inventory depletes toward 50 million ounces, margins get hiked. Private cash premiums are offered. Spot surges 10 to 30%, potentially toward $95 to $115 per ounce. PSLV could trade at a 5 to 10% premium to NAV as physical scarcity becomes undeniable. In the extreme case, over 75% delivery demand from remaining open interest, the exchange invokes Rule 701. Cash settlements at 20 to 50% above spot. Spot prices could gap explosively to the $150 to $200 range or higher as the paper-physical disconnect becomes structural. PSLV's net asset value, tied to 210 million allocated ounces at the Royal Canadian Mint, reprices with the physical market. The people who are most exposed going into Friday are holding paper claims on an exchange that has, even after the roll-offs, approximately 1.3 paper ounces for every one deliverable registered ounce, while sitting on a delivery rate from the previous month that ran at 98%. You are not that person. Let me now give you the 3 specific moments between now and Friday where this situation can escalate rapidly. Write these down. Tonight, February 25th, at approximately 6 o'clock p.m. Eastern, the CME publishes the Daily Vault Report. This report will show exactly how much registered inventory moved on today's delivery notices. Watch for whether that number drops below 85 million ounces. If it does, the math going into Friday becomes even more structurally strained on paper than it already is. Wednesday, the first full overnight session with Shanghai trading again after reopening. 2 consecutive Shanghai sessions of Chinese institutional buying would confirm that the demand compression from the 10-day closure is releasing in a sustained way rather than a single-day reaction. Watch the Globex silver ticker Wednesday night, starting at 6 o'clock p.m. Eastern when Asian markets open. Thursday, the day before first notice day. Thursday evening you will be able to see the updated March open interest figure. If large funds have been quietly rolling or closing, Thursday's number will reflect it. If the number holds above 20,000 contracts going into Friday, monitor delivery demand closely, because even a fraction of that at February's delivery rates will put serious pressure on registered inventory levels. Tonight at 6 p.m. Eastern, Wednesday overnight, Thursday's open interest. Those are your 3 data points between now and the most important morning of this silver cycle. Before I close, I want to address the question that every PSLV holder is sitting with right now. What do you actually do with your position before Friday? I am not a financial advisor. This is educational analysis based on verified public data. Nothing in this video is financial advice, and you should consult a qualified financial professional before making any investment decision. But I can show you the structural picture and let you draw your own conclusions. You hold PSLV. PSLV holds allocated physical silver in Canadian government vaults. That silver does not care what the paper futures market does on Friday. If COMEX experiences any form of settlement disruption, cash settlement, force majeure, delivery delays, the paper price of silver becomes disconnected from the physical price. Physical holders and physically backed trust holders like PSLV are structurally insulated from that disconnection in a way that SLV, AGQ, and silver mining stocks simply are not. If Friday produces a sharp paper sell-off while PSLV holds its NAV or flips to a premium, that is confirmation that the physical floor is intact. That is the same pattern you already watched during the crash. Physical premiums at dealers holding at 30 to 40% above spot, while paper silver crashed to $72. Structure matters when the system is under stress. You have chosen a structure that holds the actual asset. What you want to watch for between now and Friday is not whether to act. It is how to read what happens. Watch the 3 moments. Watch the vault report. Watch Shanghai. Watch the open interest. And watch for my Thursday night video. Because that video, the night before first notice day, is going to have everything you need before the 9:30 a.m. Eastern Open on Friday. Smash that like button if this gave you clarity on where PSLV stands going into the most consequential first notice day in modern silver market history. Subscribe right now. The Thursday night video is the most important one I record this week, and you need to be there before Friday morning. Drop a comment below. Are you holding PSLV into Friday, or are you watching from the sidelines? I read every single comment. All sources are numbered and linked in the description. Verify every number yourself. Do your own research. This is not financial advice, educational analysis only, based entirely on verified public data. I'm OG John AG, Thursday night.